This is the November update of my stock market portfolio. For the past month, I am up 3% or $4,000, $4,250 to be exact. And you might notice that this number is changing, and that's because the market is still open. For the past 3 months, this portfolio is up 6.51% or $8,560. For the past 6 months, this is up 13.61% or $16,792. And for the past year, get this, this is up 21.67% or nearly $25,000. And all my accounts are up. My TFSA, which is the tax-free savings account, an account made by the Canadian government that you can use to invest and withdraw your gains tax-free, is up 30% all time. My FHSA, or the First Home Savings Account, another account made for first-time home buyers to save and withdraw completely tax-free towards a house down payment, is also up nearly 23%. My RRSP, or the Canadian version of the 401k, is also up 13.82%, and a non-registered, also known as a cash account or a margin account, is also up 4%. You will notice that my TFSA is up way more than my non-registered because I wanted to max out the TFSA, FHSA, and RRSP first before investing in a margin account. Once again, because these are tax advantage accounts, I don't want to be paying tax on my gains, and a way of doing that is investing in retirement accounts or tax-free accounts. You'll notice that my crypto is down 10%. That is okay. Crypto can sometimes be up 30%, down 10%. I only have $2,000, which is less than 1% of my portfolio in crypto. Not really concerned about the short-term movements of crypto, as long as I can get some of those long-term gains if the cryptocurrency industry actually does end up doing well. So what did I add to this portfolio in the last month? My biggest buy, as always, remains in the S&P 500, the 500 biggest companies in the United States of America. I bought nearly $571 worth of this, and also I believe, another $142. So around $700 or $800 worth of the S&P 500. This has been a juggernaut. This has been up massively for me over the last year to the tune of 28% on average. When people were chasing 5% yields when the stock market was down a couple of years ago, this is what I was doing. I was buying the best index on the planet, especially if you're young and can hold for decades. I just thought this was the right move to make, and I'm actually glad that I made this move. I also invested in the NASDAQ 100 through this ETF called HXQ. The NASDAQ 100, similarly to the S&P 500, contains 100 of the biggest companies in the United States of America. This is extremely tech focused. If you think tech is overrated and not going to do anything and not going to add value, you might want to avoid this. Not financial advice, of course, just my humble opinion and what I think people should be doing if they don't like tech. For me, I think tech is still going to create a lot of value. Everything that we use is technology, from this camera to this laptop that I'm looking at, to the app that I'm using to invest, to the phone that I use to call people, anything, the mic, I can go on and on. This is all technology, and tech companies are going to be massive value creators in the future, which is why I chose to invest in the NASDAQ 100. My next investment was in a leveraged S&P 500 ETF. The S&P 500 has returned around 10% annualized for the last few decades. Leverage adds on an extra layer to that. For example, if the leverage amount is 25%, that means that the return is going to be amplified, and your return is going to be 12.5% since there's 25% leverage on your holdings. But there is a catch to that. Number one, you have to pay leverage costs. So your return, in fact, is going to be around 12%, assuming a 0.5% cost of leverage. And on the other side, for example, in the next decade or so, if it turns out that the S&P 500 actually does not do well, your losses are also going to be magnified. Let's say it goes down 10%. You are in fact going to be down 12.5% plus leverage costs, so 13%. For someone like myself who does believe in the long-term potential of the S&P 500, I think it's a good risk to take, especially now that I'm young and can withstand those market drawdowns and peaks and valleys. As you can see, I haven't invested a lot into this, just $45. Yep, just $45, nothing in comparison to my S&P 500 and NASDAQ 100 holdings, but enough to keep me interested and see if this is actually a good investment strategy. What does leverage actually do in the long run? If it's good, I might hold on. If it's not, I might never buy leverage ETFs again. If you enjoyed this breakdown so far, please smash the like button and the subscribe button if you like learning more about money, how to make more, save more, or just understand it better. Every subscriber and every like really helps getting this video to the right people that are actually interested in money and transparency about money. So those were my big US ETF buys. What about companies? My biggest company buy was in Microsoft, tech giant, tech behemoth. Microsoft has been around forever now, for what it seems like forever now, and I personally think it's going to be a solid company in the future as well. Their products are extremely sticky. If you think about Microsoft Office, for example, Excel, Word, and PowerPoint, they've been used by companies for decades now, and they don't seem to be moving away from them, with industries like finance in particular being heavily reliant on Microsoft products. And now they have Microsoft Azure, or their cloud offering. Cloud has expanded in the last decade, and Microsoft has seen huge dividends from this cloud expansion. And as more companies move on to the cloud, Microsoft is going to see an expanding margin, since they're going to be able to charge whatever they want practically for their cloud offerings. They've also been investing in the AI race with partnerships with ChatGPT, or OpenAI I should say, and also they're doing really well in cybersecurity, a field that is not talked about a lot but is going to be extremely important in the future. I also bought one share of Procter & Gamble, or P&G. This is a consumer goods behemoth. Any product that you use in your house, in your washroom, your bedroom, or your kitchen, from food all the way to tissues and baby products, P&G manufactures that, and they buy and acquire brands as they scale that are popular with consumers, since they have a large cash reserve. Over the past few decades, they've been steadily expanding their margins and increasing their revenue, nothing like Apple, Microsoft, or other tech companies, but this is also a dividend play. P&G and other consumer packaged goods companies redistribute a portion of their profits to shareholders like myself in the form of dividends. By buying P&G, I am not only taking part in that modest growth, also that increasing dividend, with the last 10 years in particular, P&G increasing their dividend by around 7% on average, which means every 10 years the dividend is going to double. I also bought one share of Google. Google is once again a tech giant, a search giant. As long as there's companies willing to sell, there's going to be advertisers that are going to take advantage of that and charge these companies a lot of money. YouTube is also a successful social media product, and my favorite product is Google Cloud and their GCP offering, with a lot of startups and newer companies preferring GCP due to the customizable nature of the cloud offerings that they offer. Compared to Apple and Microsoft, Google has actually not returned a lot in the last 2 years, but this is where I think the opportunity lies. Their PE ratio is under 25, which for me is bananas. The market seems to think that Google is done. Google does not have any future growth opportunities, but with this cloud revenue in particular, their Google Pixel products doing extremely well and expanding, so that's hardware, and Gemini, which has not done well so far, also coming into play, and with Google having the most amount of data, they'll always be in prime position to take advantage of this AI race. And just yesterday they released earnings. I bought this before earnings, but yesterday they released earnings which said that they smashed cloud revenue, they smashed all EPS estimates. In fact, they also saw an increase in advertising revenue since interest rates are now falling. Companies have more money to spend on ads and expanding their products. I think it's a solid company. I think it's going to be around forever until search and advertising is around, and I bought one share of it. My last US individual company buy was Fortinet. Fortinet is a cybersecurity company. They have products all the way from firewalls to VPNs and other cybersecurity offerings that keeps employees safe and companies safe when they're trying to access protected resources. The cybersecurity market, like I mentioned before in this video, is not really talked about a lot, but it's going to be extremely pivotal in the future, because if you think about it, everything's going to go online, everything's pretty much already online, but people don't take their security seriously. But threat actors are going to become even more complex, even more intelligent, especially with AI and machine learning coming into play. So companies like Fortinet offering defense mechanisms are going to be increasingly valued and are actually going to be able to charge a premium on their products. My last solely US buy was an HYLD. This is an ETF that is a covered call ETF and adds leverage to that. Essentially, that means that it sacrifices some long-term growth for income now. A covered call strategy is a strategy I've talked about plenty of times on this channel. If you're new to it, I'll link a video to this, and also you can search it on your own time online. But the bottom line is that I'm willing to sacrifice some long-term growth, not all of it. This ETF has actually been up for me 7% on average over the last few years, but I'm willing to sacrifice some long-term potential growth for income now. Seeing income grow up every month is a good motivating factor, especially for me, to stay focused, stay consistent with investing and saving, and I think it's a good enough value proposition to stay consistent. Moving on to the Canadian market, my first Canadian buy was in this ETF called BDY. This is an ETF tracking the TSX 60 or the Canadian S&P 500 with the element of it actually paying a nice dividend yield between 4 to 4.5%, sometimes even as high as 4.8% given the stock price. It contains most major Canadian companies, from banks to telecoms to insurance companies, stable companies in the Canadian economy, companies that are not going anywhere anytime soon, especially with interest rates now falling in the Canadian economy, and a lot of these stocks being interest rate sensitive, especially banking stocks and telecom stocks. I think BDY is going to do well in the near future and the far future as well. I don't know if far future is actually a term, but in the future as well. I also invested roughly $100 in AGQL. This is an enhanced ETF that adds leverage onto a balanced growth ETF. Around 50% of its holdings are in the American market and 30% are in the Canadian market. By adding leverage, it magnifies those returns. It might not be an absolute return play, since honestly investing in the American market might give me the highest amount of return, but that leverage element sort of makes up for that missed out return and also allows me to invest in the Canadian market as well. This also pays a negligible dividend, so that's also a motivating factor, seeing those $5 or $6 compound every month. My first Canadian company buy was in the Bank of Nova Scotia. This had been beaten down because interest rates were high and bank stocks are extremely interest rate sensitive, but with interest rates falling, this has seen a nice recovery, and I particularly like their expansion in South America, in the Caribbean, in international markets. Especially with interest rates falling, I think they're going to see a nice recovery in profit, a nice expansion in revenue, and that is why I chose to buy one share of PNS. My next Canadian company buy was in TELUS. This is a telecom stock, one of the 3 biggest in Canada, extremely beaten down, still beaten down because of an increase in interest rates. Telecom stocks are extremely interest rate sensitive just because they need capital to expand, and capital comes in the form of loans. If you have to pay a high debt cost to expand and put up more cell towers, put up more cell lines, you're not going to see a nice increase in profit. But now with interest rates falling, I think telecom stocks, not just TELUS, but other stocks like Bell and Rogers even, might see a nice recovery because they're going to be able to expand much quicker and pay less debt servicing costs. My last Canadian individual company buy was in Manulife Financial. Insurance, one of the 3 biggest industries in Canada, 3 industries that have dominated the Canadian economy and don't seem to be undominating anytime soon. Manulife Financial has seen a tremendous increase in price and also expanding profit margins and increasing revenue, in particular because of their expansion in Asia. Particularly why I like Manulife Financial is also why I like PNS. They're looking outwards, not just towards the Canadian economy, for growth. And I think with interest rates falling throughout the global economy, they're going to see even more benefit from this. So I bought one share of Manulife Financial. My last buy in the Canadian economy was in this ETF called HDIV. This is a covered call ETF that tracks roughly the TSX 60 plus some exposure to the American banking industry. This ETF also adds leverage, which, as we've talked about, magnifies those returns and those dividends that the ETF gets. I understand this also sacrifices some long-term potential growth for income now, but this allows me to invest in the Canadian economy while also giving myself some motivation as I see those dividends come in and that income increase month over month. Good enough to buy $71 off. Well, not just 71, I think I bought more. 71 plus 88, so that's around $150. Good enough to buy $150 off. We've talked a lot about the buys and the total value, but how has this portfolio actually returned in the past few years that I've actually been investing? Well, my biggest position, the S&P 500, has returned me an average of 28% over the last few years that I've been investing. Let's just say the last couple of years that I've been investing, so 14% per year. BDY, my second biggest holding in the Canadian market, has also returned me 15% over the last couple of years. That turns out to around 7.5% per year, plus that 4% dividend yield. So the total return for this is also roughly 11 to 12%. Apple, my biggest individual company holding, has returned me around 34% over the last 2 years, an average return of 17% per year, with other individual holdings like Microsoft returning me 22% and Google, my other big tech holding, returning me around 18%. My two biggest dividend plays when it comes to individual companies, P&G and Pepsi, have lagged the overall market, with P&G returning me positive 10%, so that's around 5% per year plus dividends, so let's just say 8% per year, but Pepsi actually being down 4.2% over the last 2 years that I've been investing. If you take into account the dividend that Pepsi pays, which is around 3%, this return is in fact positive, but Pepsi has lagged the overall market due to the increase in interest rates and market sentiment being that maybe Pepsi is not going to be able to increase revenue at a high enough rate. HXQ, or the Nasdaq 100, has returned me 11.27%, and HQL, the leverage all equity ETF, having returned me nearly 8.3%. And surprisingly, the covered call ETFs, the two main ones in my portfolio, HDIV and HYLD, both having returned me 12%. If you take this into context, that is 6% per year because I've been investing for 2 years, plus the dividend yield, which is extremely high at 12%. So the total return for both of these is around 18% per year. 18%, that is just incredible for a covered call ETF. USSL, or the leverage S&P 500 ETF, has also returned me nearly 7% since I've started investing this year. The returns, as you can see, are magnified, although we are in a bull market currently, so I don't know how this is going to perform when there is a bear market, but for now, I think this has been a good decision by me. A smaller American holding, American Express, credit card company that particularly targets the travel niche, is also up 13% for me. I think as interest rates go down and people travel more and return to normal levels of travel, American Express is going to see a nice recovery since they target that niche in particular. That's their bread and butter. My biggest Canadian holding, the Bank of Nova Scotia, is up 11% for me, or nearly $440. Plus the dividends, which adds 6 or 7% onto the return. Absolutely incredible. Manulife Financial is actually up 42% for me because of their massive increase in revenue and also pays roughly 4% in dividend. TELUS, my last big Canadian holding, is actually down 7.54%. If you take into account the dividend, it's up, or I'm actually breaking even. Not too concerned about this since, as I've mentioned before, with interest rates going down, I think TELUS and other telecom companies are going to be able to expand quicker, acquire more customers, and we should see a nice recovery in the stock price. Overall, my biggest returner is Shopify, up 56%. I don't plan on adding to this position. Maybe I will add a couple shares here or there, but I bought this since interest rates were up. But now with interest rates going down, they're going to be able to acquire customers more easily, get more debt, expand more, hire more people, and they should see a nice increase in stock price. But growth companies are a double-edged sword. My biggest loser is also a growth company, Snowflake, the data cloud as they call it now in the tech space. This company has seen an increase in revenue massively, but has not been able to control costs, which the market is not seeming to reward at this moment in time. And no, the title of the video is not wrong. I also have an employer match RRSP that contributes to this overall number. Employers in the US and Canada take part in what is known as retirement matching. You put X amount of money into a retirement plan and they match it by putting the same amount, or at least a percentage of it. My employer does this and I partake in this as well. My employer match RRSP, as you can see here, is up to $26,434. My contributions have been nearly $11,000 and my employer has matched $11,000 as well, with a good return of nearly $5,000. And how I like to look at this is I contributed $11,000 and I got nearly $15,000, or rather $16,000 from my employer. A more than 100% return. I understand that the management fee for the managed RRSP is extremely high at around 1.5 to 2% compared to 0.05% in an ETF, but I am getting that over 100% return just from the matching itself. I think it makes sense. I partake in this and I think I'm going to keep on doing it just for that return. For an average investor like myself, 100% return is absolutely amazing. Moving on to my favorite part of the video, and maybe some of you also like this, is the dividends portion. One of the reasons that I invest is also to get dividends and to get this income passively that I believe one day I can use to do whatever I want. Right now, I just simply reinvest, but I do want to use some of this income maybe 10, 15, 20 years down the line to actually make a purchase. That would be extremely satisfying that I started this 15 years ago, and 15 years from this point, I'm able to use my dividend income to actually buy a meal or maybe even buy a house, who knows. Probably not a house, but a meal is also fine. This portfolio now gives me $4,476 in annual dividends. That turns out to $373 a month, or $12.23 a day. $12.26 a day, sorry. The yield on cost is 6.73% and the current yield is 3.2%. This simply means that my portfolio has gone up in value as we've seen in the performance breakdown. My biggest pairs are the covered call ETFs HYLD and HDIV. One of the reasons I choose to invest in them, and I've said this plenty of times, is this dividend income. With HYLD in particular paying me $1,045 a year, $1,000. We divide the ETF tracking the TSX 60 roughly, does pay me around $1,000 in dividends now. $1,000. So I have two $1,000 pairs. Extremely motivating. Some other bigger pairs include the S&P 500, the Bank of Nova Scotia, TELUS, Pepsi, Procter & Gamble, BCG, Manulife, and Enbridge. You'll notice a lot of Canadian companies here, which is the primary reason of investing in the Canadian economy and Canadian companies in particular, is to take part in getting these dividends. Tech companies like Microsoft, Google, and Apple don't pay a lot of dividends now, but are increasing their dividends steadily at a high growth rate. So who knows, maybe 15 or 20 years from now, this $69 from Microsoft would be $6.90. Who knows? I'm just gonna keep on investing and see how quickly they increase dividends. That's it, that was the breakdown. If you enjoyed this video, please don't forget to smash the like button and the subscribe button if you like learning more about money, how to understand it better, or simply good transparency around the topic of investing, since there are a lot of scams online. I hope you enjoyed this and I'll see you in the next one.